What if I told you that where you live and how you invest and where others live could be one of the most powerful tools for building wealth? For employees working 9 to 5 jobs, real estate often feels like a distant dream. Big down payments, mortgage jargon, market volatility, it all seems overwhelming. But the truth is, real estate isn't just for moguls or millionaires. It's one of the most accessible ways to grow your wealth, even while working a full-time job. Today, we're exploring how real estate can be a game changer for employees, from homeownership to investment properties and REITs. Let's start with the eternal debate: buying a home versus renting. Many people believe owning a home is a guaranteed way to build wealth, but the reality is more nuanced. Homeownership can indeed be a smart move. Your mortgage payments build equity, which is essentially forced savings. Over time, as property values rise, that equity grows. But buying a home isn't always the best choice. If you're in a city where renting is significantly cheaper than buying, or if your job requires frequent relocations, renting might be the smarter financial decision. Renting gives you flexibility and often frees up cash flow for other investments. So, how do you decide? Start by calculating your rent-to-buy ratio. If home prices in your area are more than 20 to 25 times the annual cost of renting, it's often better to rent and invest the difference. For example, if renting costs you $20,000 a year, but buying a comparable home would cost $500,000, that's a 25-to-1 ratio, leaning toward renting. On the other hand, if the ratio is lower, buying might make more financial sense. Now, let's move beyond where you live to how real estate can work for you. Investment properties are one of the most direct ways to generate wealth through real estate. Here's how it works. You buy a property, rent it out, and use the rental income to cover expenses like the mortgage, property taxes, and maintenance. Over time, as you pay down the mortgage and property values increase, you build equity and wealth. But here's the catch: being a landlord isn't for everyone. It requires upfront capital, time, and effort. From screening tenants to handling repairs, owning rental properties can feel like a second job. If you're interested but not ready for that level of involvement, consider starting small with a single-family rental or even partnering with others to share the responsibilities. For employees looking for a hands-off approach to real estate investing, REITs, real estate investment trusts, are an excellent option. Think of REITs as mutual funds for real estate. They pool money from investors to buy and manage income-producing properties like apartment complexes, office buildings, and shopping centers. As an investor, you earn a share of the profits through dividends, without ever having to deal with tenants or toilets. The beauty of REITs is accessibility. You can buy shares of REITs on stock exchanges just like you would with any other stock. They're affordable, liquid, and offer a way to diversify your portfolio with exposure to real estate. For employees with limited time or capital, REITs provide an easy entry point into the world of property investment. But how do you choose between physical real estate and REITs? The decision comes down to your goals, resources, and risk tolerance. Owning property offers greater control and the potential for higher returns, especially if you're leveraging mortgages. However, it also comes with more risk and effort. REITs, on the other hand, offer consistent returns, minimal effort, and lower entry costs, but lack the direct control of owning physical assets. A balanced strategy could involve both: owning property for long-term growth and using REITs for diversification and passive income. Let's also talk about real estate crowdfunding, a relatively new way to invest in property. Platforms like Fundrise and Realty Mogul let you pool money with other investors to fund real estate projects. In return, you earn a share of the profits. Crowdfunding is an excellent middle ground between REITs and direct ownership, offering higher returns than REITs with less effort than being a landlord. However, it's important to research the platform's fees, track record, and project risks before diving in. One critical factor in real estate investing is location. Whether you're buying a home, rental property, or investing through REITs, location significantly impacts returns. Look for areas with strong job markets, population growth, and high demand for housing. These factors drive property appreciation and rental income potential, making your investment more profitable over time. Finally, let's discuss financing. Real estate often requires significant upfront capital. but there are ways to minimize the barrier. For first-time homebuyers, government programs like FHA loans, or equivalent in your country, allow you to buy with as little as 3 to 5% down. For investment properties, consider house hacking, buying a duplex or triplex, living in one unit, and renting out the others to cover your mortgage. This strategy combines homeownership with rental income, accelerating your wealth-building journey. So, how do you get started with real estate? First, define your goals. Are you looking for a place to live, a source of passive income, or long-term growth? Next, educate yourself. Learn about the local market, financing options, and potential risks. Start small, whether that means saving for a down payment, buying a single REIT, or exploring crowdfunding. The key is to take that first step. Real estate might seem complex, but with the right strategy, it can be a powerful tool for building wealth. Whether you're buying a home, investing in rental properties, or exploring REITs, the opportunities are vast. Start where you are, use what you have, and let the power of real estate grow your financial future. The best time to invest was yesterday. The next best time is today.